One man, one testimony, and the gold market has no idea which version of him is about to walk through that door. On January 30th, 2026, Donald Trump announced Kevin Warsh as his nominee for Federal Reserve Chair. Gold was trading near $5,600 per ounce. By the time that session closed, it had fallen to $4,745. $1,200 gone in hours. Silver collapsed 31% in a single day, the worst performance since 1980. Not a crash caused by economic data, not a crash caused by war or pandemic or banking failure, a crash caused by one man's name being announced on a Friday afternoon. That is how much power this appointment carries. That is how completely the market repositioned around a single nomination. And now that man is about to testify. He is going to sit in front of the Senate Banking Committee and answer questions under oath. And the gold market is holding its breath because nobody, not the analysts, not the banks, not the traders, who have spent months studying this man, nobody knows which Kevin Warsh is going to show up. That is the story. That is what the mainstream coverage is missing. They are treating this as a procedural confirmation hearing, routine politics, a formality before the inevitable. But this is not routine. This is the most consequential monetary policy testimony in years. Because inside that hearing room, one of two things happens. Either the 2011 Warsh walks in and gold retests 4,500, or the 2025 Warsh walks in and gold explodes back toward 5,500 before the week is out. There is no middle ground. The positioning is too extreme. The leverage is too high. One version of this man walks in and the entire precious metals complex reprices in real time. Let me explain who Kevin Warsh actually is. Because the financial media keeps describing him in two words. Inflation hawk. And if you only read the headlines, you would think this is simple. Hawk means higher rates. Higher rates means stronger dollar. Stronger dollar means weaker gold. End of story. But that is the shallow reading. That is the version designed for people who do not dig deeper. The real Kevin Warsh is far more complicated. And the complexity is exactly what makes this testimony dangerous. From 2006 to 2011, Warsh served as a Federal Reserve governor. He was 35 years old when he was appointed, the youngest person to hold that role in the Fed's modern history. His mentor was Alan Greenspan. His father-in-law is Ronald Lauder, a billionaire with deep ties to Republican politics and a close personal friendship with Donald Trump spanning decades. This is not an outsider. This is not a disruptor. This is someone who has been embedded in the highest levels of American financial and political power his entire professional life. During the 2008 financial crisis, Warsh was instrumental. He was the Fed's liaison to Wall Street during the acute phase of the meltdown. He was in the room during the emergency decisions. He understood what systemic collapse actually looks like from the inside. And when the crisis passed, when the question turned from survival to recovery, Warsh showed his true instincts. He pushed back against quantitative easing. He wrote public dissents. He argued that the Fed was creating dangerous imbalances by flooding the system with liquidity. In 2011, after the Fed launched QE2, Warsh resigned. He walked away from one of the most powerful jobs in global finance because he believed the institution was making a catastrophic error. That is the 2011 Warsh, and that is the version the gold market priced in on January 30th. Because if you are a gold investor, quantitative easing is your best friend. When the Fed expands its balance sheet, when it creates money to buy bonds, the purchasing power of the dollar erodes. Real yields fall. And gold, which offers no yield but also suffers no debasement, becomes the most rational store of value in the room. A hawk who hates QE, who believes in sound money, who thinks the Fed has been recklessly loose for years, that is existential for the gold bull thesis. That is the scenario where gold falls to 4,000, 3,500, back to the pre-bull market levels that most people have already forgotten. But here is what changed. Here's the part that explains why the market may be catastrophically mispriced right now. Because the 2025 version of Kevin Warsh is not the 2011 version. Not even close. In the years since his resignation, Warsh moderated. He began aligning himself more closely with Trump's economic worldview. He became a vocal critic of Jerome Powell, but not for the reasons a traditional hawk would criticize a Fed chair. He was not criticizing Powell for being too loose. He was criticizing Powell for being too slow to respond to changing conditions. He was echoing Trump's frustration that the Fed was not cutting rates fast enough to support growth. Warsh began arguing that productivity gains from artificial intelligence and technology could sustainably lower inflation, which would create room for rate cuts without triggering price spirals. He was building an intellectual case for why aggressive monetary easing could be justified. And then he made a move that no one in the mainstream is discussing seriously enough. He became a public advocate for closer coordination between the Federal Reserve and the Treasury Department. He argued that the artificial separation between monetary policy and fiscal policy had become a liability in the modern economy. that the Fed needed to work more closely with the government to address structural challenges like housing affordability and growth. This is not hawkish language. This is the language of someone who is prepared to use the Fed's balance sheet as a policy tool. This is the language that, if translated into action, means more money creation, more dollar debasement, more gold. So which version shows up to the confirmation hearing? The man who resigned in protest over QE2, or the man who spent the last 4 years building a case for why the Fed and Treasury should work together? The market bet on version 1. The crash on January 30th was a bet that version 1 was real and permanent. But what if version 1 was the past and version 2 is the future? Watch the specific language in his testimony, because the words matter more than the tone. There are phrases that signal each version with precision. If you hear Warsh talk about price stability as the Fed's primary and overriding mandate, that is version 1. That is the hawk who subordinates growth to inflation control. Gold goes lower. If you hear Warsh talk about the Fed's dual mandate with equal weight given to both maximum employment and price stability, that is version 2. That is the pragmatist who can justify rate cuts when unemployment rises. Gold goes higher. If you hear Warsh criticize the current level of the Fed's balance sheet and signal his intention to reduce it aggressively, that is version 1. Quantitative tightening on steroids, liquidity drain, dollar strengthens, gold falls. If you hear Warsh talk about using Fed tools to address structural economic challenges like housing or credit availability, that is version 2. That is someone who will expand the balance sheet when politically convenient. Dollar weakens. Gold rises. If you hear Warsh express skepticism about the timeline for rate cuts and suggest the Fed needs to stay on hold through most of 2026, that is version 1. Higher for longer. Real yields stay elevated. Gold struggles. If you hear Warsh suggest that productivity gains from AI and technology create conditions for easing, that he sees a path to lower rates without triggering inflation, that is version 2. That is the setup for the next leg higher in metals. One more signal. Watch how Warsh handles questions about Federal Reserve independence, because this is where his political positioning becomes relevant to monetary policy. If senators push him on whether Trump can pressure him to cut rates and he responds with strong defenses of institutional independence, that is reassuring to markets in the short term but potentially bearish for gold. Because a truly independent Warsh, who runs the Fed by the traditional book, is more likely to prioritize inflation control. If he hedges, if he suggests that the Fed needs to be more responsive to democratic accountability, more aligned with the executive branch's economic goals, that signals something very different. That signals a Fed that will bend toward political pressure for lower rates when unemployment rises, and election cycles create urgency. The January crash priced in absolute independence, absolute hawkishness, pure version 1. Any deviation from that, any sign that Warsh is more nuanced, more politically aware, more willing to use the Fed's tools creatively, and the repricing happens fast. Because the market is positioned for the worst case for gold, and when positioning is maximally pessimistic, it does not take good news to trigger a rally. It only takes less bad news than expected. But here is what almost no one is discussing. Even if version 1 shows up completely, even if Warsh delivers the most hawkish testimony imaginable, the gold bull thesis does not die. It gets delayed, and delay is not destruction. Central banks bought 863 tons of gold in 2025, the highest rate since 1967. China bought 15 consecutive months without pause. India repatriated 280 tons from foreign vaults. These decisions are not based on what Warsh says in February. They are based on where the dollar is in 5 years, and whether the current fiscal trajectory is sustainable. The arithmetic is unambiguous. U.S. national debt crossed $38 trillion. Annual interest payments approaching $1 trillion per year. The CBO projects $2 trillion annually by 2036. At some point, regardless of who runs the Fed, the United States will need to monetize debt, not because anyone chooses to. Because the alternative is default, and default is the one outcome every American institution is designed to prevent. Warsh's testimony is a timing event. It tells you whether the rally pauses or resumes immediately. It does not tell you whether the rally is over. There is also the silver dimension, because silver in this environment is not just following gold. Silver is amplifying every move with its own industrial demand story layered on top. The Silver Institute confirmed 6 consecutive years of structural supply deficit. Global silver demand is forecast to outstrip supply again in 2026. Industrial consumption from solar panels, AI data centers, electric vehicles, and 5G infrastructure is absorbing metal at rates that mining cannot replace. When Warsh testifies, silver will move 2 to 3 times the percentage of gold in whichever direction the market decides. If gold rallies 3% on dovish signals, silver rallies 6 to 8. If gold falls 2% on hawkish language, silver falls 4 to 5. This amplification is not random. It reflects silver's dual nature as both monetary metal and critical industrial input. The monetary side tracks gold. The industrial side adds its own momentum. And right now, both sides are pointing in the same direction. The confirmation timeline matters. Powell's term as Fed chair ends in May 2026. Warsh needs Senate approval. Senator Tom Tillis has publicly threatened to block all Fed chair nominees until an investigation into the Fed's building renovation project is resolved. This is not a procedural formality. This is a senator with a specific grievance using his leverage to create delay. If the confirmation process extends past April, there is a period where the Fed has no confirmed chair, where monetary policy is made by an institution in transition, where market participants cannot price in the next chair's preferences because those preferences have not been tested in the actual job. That uncertainty period is historically bullish for gold because uncertainty about monetary policy drives capital toward assets that exist outside the fiat system. Watch the markets tomorrow. Watch how gold trades before the hearing opens. The positioning ahead of testimony reveals what smart money expects. If gold is rallying into the hearing, the market is betting on version 2. If gold is selling off, the market is doubling down on version 1. And watch the first 60 minutes after Warsh begins speaking. The algos will react to specific keywords before the humans finish processing the full context. Hawk, inflation, dual mandate, balance sheet, coordination. Each word triggers a response. The cumulative response of those first 60 minutes tells you what the machine's decided version he delivered. This is not a normal hearing. A senator asking a nominee about regulatory policy or banking supervision would be routine. This is a hearing where every answer carries a price tag, where the difference between two carefully chosen sentences is a $100 move in gold, where the person being questioned knows exactly what the market needs to hear to maintain stability, which means he also knows exactly what he needs to avoid saying to prevent a rally that he may or may not want to trigger. The man who crashed gold $1,200 in a single afternoon is about to face questions under oath. In the gold market, the silver market, every precious metals position held by every institution on the planet is waiting to find out which version of Kevin Warsh actually exists. The ghost of 2011, or the pragmatist of 2025. The answer determines the next $1,000 of direction. And the answer comes when he opens his mouth. Pay attention. Because by the time the analysts finish writing their summaries, by the time the reports get distributed and the headlines get written and the mainstream coverage explains what happened, the market will have already moved. The ones who watch the testimony in real time, who understand what the specific language signals, who know which phrases mean which version arrived, they will have already repositioned. The ones waiting for a summary will be chasing a price that left the station an hour ago. This is not financial advice. This is pattern recognition. Verify his testimony yourself when it publishes. Read the actual transcript. Count the number of times he uses the word inflation versus employment. Count how many times he references the dual mandate versus price stability alone. The language is the signal. The signal is the price. And the price is moving whether you are watching or not.